Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
We encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to today's podcast. We got a small but intellectually powerful group with us here today. I am Nathan Merrill of Goodspeed Merrill, and I have with us Mike Miller of Miller and Associates CPAs. And Mike's been absent from us for a while because he's been relocating some of his practice, himself in particular, down to Texas. But everything's still up and running here locally. Isn't that true, Mike?
Yeah, thanks, Nate. We're here. We're here locally still. Our office is open and will be open. It's not going anywhere. I'm just working kind of remotely down in Texas right now, and then coming up once a month for about a week or so, and meeting with clients and getting my staff in order. And
I think we've talked about this in past podcasts, where it's kind of one of the beautiful things. If there's a beautiful repercussion of COVID, it's that we've kind of all figured out how to expand our reach and become a little more mobile and work where it's convenient, in a sense.
Right. And I have clients pretty much across the country and several in different countries around the world. So for me, it's always kind of been this way.
Yeah.
Before even COVID hit, we were moving towards this approach of how do we set up more virtual, offices across country. Especially
with clients who, we were talking about this on a recent podcast, me and Jeff, about talent acquisition is becoming a national endeavor, not just localized to where your offices are per se, because talent's becoming so difficult to come across. You'll take it wherever you can find it. But many of our clients, as you point out, have been dealing with multiple locations, and this idea of bringing together operating minds within an organization has been worked on for years. I think that the new technology definitely enhances our ability to do that effectively beyond just phone calls. But
right, and even then, you can look at talent just even outside the country. I mean,
absolutely.
United Kingdom, Australia. There's talented people around the world who do good things in the tax and accounting world.
Yeah, I'll still say America, baby.
There you go. That's right.
We're the best. No, okay. So, but today we have some interesting things to talk about. A lot of the time, some of our topics are spurred by our own experiences in our businesses, and this is right along in line with that. And so, Mike's going to educate us a bit today on some of the basics of accounting methodologies. And I refer to there as cash accounting methodology versus accrual accounting methodology, and the differences, kind of how they contrast and compare in practice. And then we'll follow up with a subsequent podcast talking about kind of the practical applications, opportunities, why you might choose one over another. So without further ado, Mike, I'm going to ask you, I think the easiest one for us to get going on is perhaps cash accounting.
Right. Yep.
So what is it? Why does it exist? And where do we see it most frequently?
So cash accounting is basically, you're running a business and you're operating your business on what's called the cash basis. There's the accrual basis also. We'll talk about that shortly. Cash basis is basically, in the very short version, it's When cash goes out the door and you're paying for something, you incur an expense, you book it in the books. And when cash comes in because you've generated revenue, it gets booked on in the revenue account on the financials when the cash comes in. There's no shifting it around in different places, different months or different years. So it's point in time, real time.
It's real time.
It's real time transactions.
So what's the strengths of cash accounting?
It's easy, first of all. I mean, your small business owners, $1 million, $5 million-ish, makes good sense just to operate that way. From a tax planning perspective, you can kind of manage the ins and outs of that cash flow.
It plugs in well with tax accounting?
Yeah. I mean, at the end of the year, it's like, okay, I've got a big tax bill. If I bill these clients and they pay me before the end of the year, I'm going to have a giant tax bill. Well, what if I don't bill them until January and they pay me in late January? I've deferred that revenue to a future period, which may or may not be beneficial depending on what the tax structure is for the following year.
Right.
Then you can accelerate your expenses by prepaying or buying stuff that the business needs, by spending cash before the year ends.
Right.
So you can manage your tax bill if you're proactive about it and understand the logistics around cash in and cash out.
So let's get into some practical understanding of some of these things you're talking about. So if I'm in the manufacturing business and I want to put a big expense in my books at the end of the year, and I order a machine that's not going to be delivered till next year, is it possible to still get that on my books?
In that situation, you're looking at what's called accelerated depreciation, either in the form of bonus depreciation or Section 179 depreciation. But you don't trigger that advance expense of accelerated depreciation until the asset's put into service.
Okay.
So if you buy it before the end of the year, but you're not using it, it's just an asset sitting on the books.
So if I put a big down payment,
it does nothing.
So I actually have to go to Costco or something and load up on a bunch of TVs for my office
right.
to be able to get them into service by year end. What other types of things do you see where people are doing that strategy of getting expenses put on the books?
They'll buy a car.
Okay.
Or a truck or some piece of big equipment.
Something that can be delivered
and put into use before the end of the year. To your point, a lot of people go out and buy electronics, whether they're TVs or computers, monitors. I'll call them entertainment systems for lack of another word, but that's not what they are. But you know what I mean? They use them in conference rooms, things like that. They may buy a conference room table set. And they may buy a lot of things for the office. They may trade out the whole office setup.
But it has to be stuff that's in inventory.
Yeah, they have to receive it and put it into service before the end of the year. They can't order it.
What about other types of expenses like prepayments on insurance premiums and bonuses and stuff like that?
If you're yes to bonuses, always. Cash is always king. So if you pay a bonus in the year, it's always good to do that. Looking at sorry, I lost my train of thought. It was the prepaid expenses. So if you're looking at if you're under a lease agreement, you can prepay. Good grief, you could pay the next year's rent payments. Mm-hmm. You could pay a full year in advance if you wanted to.
You could do that under cash.
Sure.
Okay.
You could prepay.
And we'll come back to some of these when we're talking accrual just to see how they differ.
Right.
Because I suspect that there is probably some difference between how they're treated.
Right.
Just based on my rudimentary knowledge of accounting.
And it does take a little planning because when you're looking at it, you're going, geez, what if I prepaid my rent? All of 2020 rent in 2020 to get the deduction. Well, it's great. Now you don't have the deduction in 2021, and you could have a huge tax bill depending on what the tax structure is. You may owe more in tax.
Right. Especially if you pushed off some of your revenue recognition.
Right.
And you'll have no deductions and all kinds of revenue coming in. But if the rates are going down, like you say, that may work because you want to take deductions when rates are high and you want to recognize income when rates are low.
Correct. And I have several clients who've done this in the past, very, very small clients who get surprised. I had one client who was very creative, went over to Sri Lanka, and he'd buy $250,000, $500,000 worth of electronics. And he'd come back, he'd have them shipped back to the United States and then refurbish them a little bit. Some of them were in great working order, but then he'd sell them at a pretty good price. But he'd buy them all in November, December and expense them. This is before I came along, and expense them. Mm-hmm. And so he'd have no taxes due in that current year, maybe even a net operating loss that he's carrying forward to the next year. And then the next year, he's got massive sales and a huge tax bill.
So, that just actually spurred a question I was thinking about as you were talking about it, which is how does inventory work in a cash accounting system? Is it a deduction or?
So going back to pre-28 tax reform, the IRS tax code basically said if you have $10 million or more in revenues, you have to use the accrual basis. Anything up to $10 million, you have the option of using cash or accrual. Trump came along and in 2018 said we're going to up that to $25 million. And so if you're somebody who is a manufacturer or a buyer and reseller of product, you can, if you want, expense what you buy in the year that you buy it. Recognize that the following year when you sell it, you don't have an offsetting deduction against that sales price. You can do that under current tax law, as long as you're under $25 million in revenue.
So, okay, well, we'll push, I think, where does cost of goods come into play? Is that a cash accounting concept or is that mostly accrual?
It's an accounting concept. So if you think of cost of goods sold, what is cost of goods sold? It's the cost of something you've manufactured and sold or something you've bought and resold, right? So if I go out and I buy a widget or if I go out and manufacture a widget, I have a product sitting in inventory to sell, and I have costs related to that, right? Now I can defer those costs until I have the sale and implement what's called in the accounting world matching principle. Can match the cost with the revenue that was created, right? That's
right.
We're teetering on accrual accounting.
Okay.
But we won't go there at this moment. But that's where you have cost of goods sold, right? So at the end of the month or the end of the quarter or the end of the year, whenever you're reconciling your books and getting ready to kind of report your financials, you look at it and you go, you have to make an offsetting entry to say, what's my current inventory that I have in stock? Because I haven't sold it all. So that brings into account the matching principle. If you don't do that, you're just expensing everything you produced. And maybe your sales are up, maybe they're not. But
okay,
it's a full expense item if you don't adjust out of your cost of goods the items you didn't sell. Because you can buy $100 million worth of product. And if you don't sell any of it and you expense it, it's now in cost of goods sold. That's what is cost of goods sold. Now, if you don't sell any of it, didn't generate any sales, and you want to stick that on the balance sheet, now you're going to take it out of cost of goods sold and put it on the balance sheet. You don't have this big expense. You also don't have any revenue because you didn't sell anything.
Right.
So now you've deferred the cost of that product
to when you're going to recognize
you're going to recognize the revenue and match the revenue
Okay.
with the expense.
So just wrapping up, because this isn't meant to be even accounting 101, I'm just going to wrap up or recap a little cash. So cash is simple. Cash allows a fair amount of flexibility on timing of recognition of deductions and potentially manipulation of timing of recognition of revenue. If I was on the simple side, it probably works best for simple businesses or relatively single product or service or very straightforward revenue streams. If you have revenue coming from multiple different types of businesses or divisions or that sort of thing, I assume that's where we'll be talking that accrual is perhaps a better match for the business. And it's just more intuitive.
Yeah, it's very simplistic. It fits right into the small business owner's mindset. They can grasp it. They can understand it, as we're about to find out with the accrual.
Yeah, so let's
process.
shift over to accrual now.
Okay.
So how would you introduce the concept of accrual perhaps to a new client who's coming in and you're looking at their business makeup and you're going to tell them that accrual makes more sense for you? How do you explain accrual to them?
Okay, so the scenario you're laying out is we have a business owner who's currently using the cash basis and they're comfortable with it, and they want to switch to. We feel that maybe an accrual basis would be better for them. Well, first I have to explain to them what accrual basis means. Right now, that whole expense planning thing on the cash basis, deferring revenue and accelerating expenses, kind of goes away.
Right.
But now you're forced into a position where if there's a known event, you have to accrue for it. So if you've normally rent's due like the first of the month, but let's assume it's due like the 29th of the month, right?
Okay.
So it's due around the end of the month, and you don't pay that rent at the end of the month, right? You pay it in January. You have to accrue that expense in the month that it was due, even though you didn't pay it.
So let me throw in there a little wrinkle just as a comparison point here too, because I think this used to happen to us. Rent's due on the 29th. we would cut the check and walk it over to the landlord. They were in the office next door, and give it to them, but it wouldn't actually hit our bank until the next month because they would deposit it that night and it would hit the bank on the 1st or 2nd. So it would actually show up because we were cash accounting, would that actually show up on our financials for the next month because that's when it actually hit the bank? Or even though our check was cut on the 29th, should it have shown up on the prior month?
Now we're going to get into a little more deep accounting.
Okay.
All right. So in the cash world, when you're looking at paying rent, you're relieving cash, as accountants call it. You're crediting cash, and you're paying a bill. You're booking an expense.
But that happens when we cut the check, or
that happens in a cash basis. That happens when you cut the check.
Okay.
When you do that in the accrual world, right? At the end of the month where the rent was due, you didn't cut the check, or did you cut the check?
Well, we haven't ever done that under our accrual methodology, but let's assume we didn't cut the check on the 29th. Under the accrual method, what would it recognize?
You would then book the expense, debit rent expense, and then you would credit accounts payable. You have a liability due to your landlord. So the following month, when you actually cut that check and send it off to them, you're relieving cash now, you're crediting cash, and you're debiting that accounts payable, that liability account. So the expense is already booked in the month that it was really due, although not paid.
And this is obviously an important distinction between balance sheet and P&L statements.
Yes, in the cash basis world, there really shouldn't be any, accounts receivable, current asset type stuff. No prepaids, no accounts receivable, no accounts payable on the liability side, no credit cards pay, those kind of things. There shouldn't be any.
Right.
Because it's all cash basis.
Right.
You don't recognize anything unless you pay cash. Okay, in the accrual world, now all that comes into account. You have prepaid accounts, you have accounts receivable, you have accounts payable where bills are due, people owe you money, things like that. Again, if there's known events, you have to accrue for those known events.
So that pulls things into expenses. Does it work the other way too? Where if you is that what prepaid is? Prepaid revenue, like you receive.
Prepaid revenue is called deferred revenue. So if somebody, if you've performed services in the month, it could be any month, but let's just pick December, right? But if you want trued up, correct financial statements, this is a monthly event, right?
Okay.
So let's say it's December, right? And
because everybody wants to get an expense, they want to pay you now,
right?
So they get the deduction,
right?
Even though you haven't performed the services yet. Let's assume they're cash. So
right. So if you've performed the service and you haven't received payment in the cash world, you wouldn't record anything.
Right.
In the new world of the accrual, you've earned your money, although you haven't been paid for it.
Okay.
You have to accrue that income that hasn't come in the door. So you're going to debit your accounts receivable. You're going to record a receivable on your balance sheet, right?
Right.
And you're going to have revenue on the books.
Okay. But I guess what I'm saying is the flip side can be true too. If someone prepays you, if you have a project and you're going to invoice them up front, or they decide to pay you the entire project cost up front, even though you haven't performed the services yet, would you put some of that onto the books as a prepaid asset and not show it in revenue, or how do you treat that?
It's a deferred. It's actually a liability. It's a deferred revenue.
Okay, deferred revenue.
Yeah, because if you think of revenue on the P&L, that's a quote unquote credit balance account in the financial world.
Okay.
Right. So when you have people that pay you a whole bunch of money up front to do the work and you haven't done it, you're going to put all that money in the bank and you're going to debit cash. You're going to create an asset in the cash account. But now you haven't done anything. You haven't earned anything. So you have a deferred revenue account. Unearned income, deferred revenue, same thing. So as you perform services,
you pull it out
and you earn it. Yeah, you now have income.
So this gets back to what you were saying before: is accrual is more of a matching principle concept. Where, am I right in suspecting that this tends to level out revenue cycles?
Yes.
Okay. So maybe you can talk to that a little bit.
So in the cash world, you're looking at peaks and valleys, right? Because you're playing a tax game and you're trying to manage your taxes. With the accrual world, what you really should be looking at is a financial statement month over month, year over year. It trends. You see the trend. There's not these huge peaks and valleys because you should be recording expenses and revenues, earned or not earned, right?
So in a law firm context, we may have a sale project that takes 60 days to complete, and we get paid at closing. In the cash basis world, we would show a dearth of revenue while we're building up that receivable, and then we'd show a huge spike when it gets collected in month 3. In the accrual accounting system, we would show constant production over that period of time.
Yep, be just a flat stream.
So, okay, so what are some of the other important distinctions with accrual?
Again, if you think about it from the income perspective, right? Now, if you've got a known event where you've earned money but haven't received cash for it, and it's December 31st, we've got this $500,000 receivable out there and we haven't been paid for it. You've earned the income. You've got to recognize the income and pay taxes on it, although you've not received cash payment for it.
Okay. So let's talk a little bit about those nasty accounts receivable. In a perfect world, you'd collect 100% of everything, especially in a professional services, you'd collect 100% of everything you bill out, but that's not always the case. And there's always I think in a lot of industries, not just professional services, there's the opportunity that a client that owes you money doesn't eventually pay it for one reason or another. How is aging handled in an accrual system, and how are uncollectibles handled in an accrual system? Because in a cash, you haven't ever recognized them into revenue.
Right. And that's kind of the interesting point when I have tax clients that come to me in their cash basis and they go, well, I perform these services, but they didn't pay me, so I have a write-off, right?
Yeah.
No, not really, because you were never paid. So you never recognize the revenue, so you never have an offset, right? Mm-hmm. In the accrual world, it's completely opposite. You have recorded the revenue, whether you've been paid for it or not. Now, the timing issue comes into play where if in January, right, you sign a contract and you perform the services and, it comes to be November and they never paid you and you wrote it off, it's kind of a wash on the financial statements. There's no big deal.
Right.
But if you signed a $500,000 contract in August and it comes to be April of the next year, well, how much revenue have you recognized in the current year that you didn't get paid for in the following year? So the following year, you got a bad debt expense. You can write some of that off, right? So you're managing receivables now. There's another management component on the accrual side. Now you're managing your accounts receivable. Who owes you money? When are they paying you? And how's that going to affect cash flow? How's it going to affect business performance?
So how does one determine that they have an uncollectible AR or?
Two things normally happen three things. First of all, the client's not paying you.
Right.
Well, why aren't they paying you? There's a dispute of services. So either you as a business owner are going to do a write-down, right, and give them a break on what they owe, or it's going to be deemed uncollectible and you're going to write it off. You're going to take it off of accounts receivable and book it as expense to bad debt expense on your financial statements, on your P&L.
And this may be too deep for our cursory kind of analysis of these different types of accounting systems, but is there a straightforward methodology to determining when that is, or is it kind of...
It should be an internal policy that's documented, right?
Okay.
So somewhere in there, you've got something documented. If you're on the accrual method, you've got internal controls and procedures that say we've done these things, and up to this point, if it's not collected by this point, we deem it to be a bad debt expense. And that can be anything from if we've not collected it after 12 months from date of service, we're going to write it off, or we're going to write it off after we've pursued legal course, whatever that policy is, you've got a collection policy. Okay. The collection policy should dictate when do you write off bad debts.
So carrying that just one step further, then, say we've written off an accounts receivable, it's still, what does that show? I'm trying to figure out the best way to ask this question. Does that stay on our books as a written off expense, so if we collect it later on, it comes in as revenue when we actually collect it, or how do we? Where does it go in the ether?
So on a year-over-year basis, your P&L zeroes out, right? Your profit and loss zeroes out. So that's a 12-month cycle. So January 1st to December 31st is your profit and loss statement. Your balance sheet's perpetual. It moves and keeps going with the business, right? Mm-hmm. So as you close out a year and you're profitable, the net profit goes into your retained earnings on your balance sheet. And then you start the next year. And if you look at January 1st 12:01 a.m., all the balances are zero. There's no revenue, there's no expenses. You haven't done anything. Then you start to, record revenues and expenses throughout the year. So when you have a bad debt that you've written off and then you collect it subsequently, you've basically received cash and now you've created. You can do it two ways. You can either book it as a credit to bad debt expense, or you can book it into other income, right, from bad debt collections. I don't like to see a credit balance sitting in bad debt expense because that just kind of freaks people out. So you either put it into other income because that's what it is.
Okay.
But then you've recorded the cash.
Okay. But that bad debt or that uncollectible AR just goes away at the end of the year then.
Yeah, you've written it off. When you write it off, you're taking it out of, you're crediting your accounts receivable, reducing your accounts receivable, your expense sitting on the P&L, it's gone. It doesn't ever carry forward.
So what are some of the other, we talked about, inventory. How does inventory treatment compare versus cash?
So now I can't throw in the hybrid just yet. We kind of talked about inventory.
Would be easier to start with prepaid, like prepaying your rent, and I guess we kind of already did address that because you can't take the expense until the events have occurred that made it an expense.
Right.
So even if you paid it at the end of the year, it would just go on your balance sheet. It wouldn't go into the...
So let's talk about prepaid expenses real quick. So if you have a contract that you have to make monthly payments on for 12 or 24 months, right? You pay it all up front, right? So in the accrual world, you can't write off the full payment when you do it. You have to spread that over either 12 or 24 months. So you set it up in the prepaid account. And then so every month, you're relieving 1/12 or 1/24 out of that prepaid account as an expense. So that's kind of how prepaids work.
Gotcha, okay.
So you could do a subscription that way where you prepay the full subscription for the year. You're not going to write off the $1,200 for the subscription, let's say. You're going to write off $100 every month.
Right.
You're going to have $1,200 sitting on the balance sheet as a prepaid.
And that only really matters when the prepayment spans 2 different tax years.
No, it can be 6 months. It can be 3 months. It can be 12 months. It can be January to December 31st. You're looking at your monthly financials. So you want your monthly financials to represent 1/12 if it's an annual contract. It doesn't have to, it can cross over the end of the year or it can't.
But in terms of deductibility of that expense, if you paid it all in 2021 and the accrual happened, and I guess I'm jumping here over to tax accrual, then you'd have to split your deduction between the 2 years, right? Even though
yes.
they would match up with your financial accrual accounting.
Right.
And maybe we'll talk about that in the next podcast where we're talking about practical implications of one or the other. And I think I just opened up Pandora's box a little here, which is cash and accrual both have different, they cross over with your tax returns as well.
Right.
So before we move on to that, let's conclude the kind of introduction to accrual. So
let's back up a second because you'd asked about inventory. We got sidetracked.
That's what I mean. I was going back there.
We got sidetracked to the prepaid. So on the inventory side of it, again, you have to look at cost. What is cost of goods sold? So if you look at a financial statement, you have cost of goods sold if you manufacture a product for resale or you buy and hold a product for resale. That's it. Under the IRS rules and regulations and generally accepted accounting principles, that's when you have cost of goods sold.
The rest of it is just overhead and
so you
labor.
can't. You can look at like a Keller Williams who will say you have cost of goods sold, and you have, they put numbers in there, right? You may have to pay if you're a broker dealer. You may have independent contractors that work for you as brokers, right? They're not employees, but they're brokers. They teach you to put the broker expense in cost of goods sold. Doesn't meet the criteria. It's not a cost of goods sold. It's a cost of generating revenue, which us accountants call overhead.
Right.
Selling and general administrative
So
expenses.
if I am in manufacturing and I buy a bunch of raw materials and it takes labor to assemble those raw materials into a product, the cost of goods sold technically for accounting purposes is still just the raw materials. The labor falls outside of cost of goods sold, the actual process of putting those materials together.
You're going to get very technical with that question.
Okay.
And I'm just going to say we'll defer that one to later.
Okay.
But if you're manufacturing a product that costs $2,000 to manufacture, all costs in. You basically record those costs in inventory on the balance sheet. And then you have one item, and then you wait until you sell it. And when you sell it, you relieve it from inventory. The kicker in the accrual cash piece is there is a hybrid component. You can be a cash basis tax filer, but you can be an accrual basis financial statement for inventory type companies, just for inventory related stuff. So your inventory and your accounts payable can be recorded on the accrual basis on a cash basis financial statement if you're a manufacturer or reseller of goods.
That's a great teaser to take us into the next episode. I'll add to that. I'm curious to hear, well, maybe we can conclude the next episode talking about FIFO and LIFO and how that all plays into what you were just talking
FIFO
about.
And what FO and
Yeah. But no, I think that's a great way to kind of wrap things up here. We've had a phenomenal introduction to kind of comparison of cash and accrual and how they relate to some basic accounting concepts. Mostly what we've been talking about here is financial reporting, with occasional talking about deduction here and there. But the next episode, I'll take Mike a little deeper into the whys, where and how you would apply these different accounting methods to make your business stronger, I should say. I mean, that's what you're all about, is helping people's financial statements help them make better business decisions and make their businesses stronger, correct?
Yeah, it's profitability, it's growth, and it's tax savings all combined into one.
So if that interests you, come back for our next episode, and then we'll get into it more with Mike. In the meantime, make it a great day, and thanks for joining us.
Thanks, guys.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us, and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.